This is Quent Bilo with a continuing discussion of cost, volume, profit. In this talk, we'll look at all the components of CVP analysis, the heart of this chapter. CVP analysis is the study of the effects of costs and sales volume, the C and the V, on a company's profits, the P. We'll calculate a new term called contribution margin and look at the various ways it can be expressed. We'll define a very key relationship in CVP analysis known as break-even analysis. At the break-even point, a company realizes no net income. Its revenues just cover all costs, both variable and fixed, nothing left over for profit. This chapter will introduce a differently formatted income statement known as the CVP income statement. And the talk will conclude with break-even point analysis, saving the balance of topics indicated for a later discussion. All of CVP analysis is premised on our previous discussion that classified all costs into either variable costs or fixed costs, not the classic product versus period cost distinction. This will give us the ingredients for a different type of income statement, one that allows us to do an analysis that can plan our expected profits. First, let's review the standard or traditional income statement, a format that's called for by GAAP. On the left is the traditional income statement. Now, this is very abbreviated, but shows us key relationships between product costs, that is, manufacturing costs incurred in the plant that becomes an expense on the income statement when product is sold. These costs, cost of goods sold, when subtracted from sales, gives an important gross profit subtotal. Deducting all other operating expenses, known as period costs, costs outside the factory, gives us bottom line net income. Let's construct a newly formatted income statement. This is one used solely by internal management, not published for external users. First, sales at the top and net income at the bottom, what remains of sales dollars after all costs are deducted. These remain exactly the same as our traditional income statement. It's what's in between that will change, how we rearrange the expenses on the income statement. We'll take all our variable costs as the first deduction from sales. These are costs that change directly and proportionately with changes in sales volume. Sales volume will be the principal activity measurement that drives our thinking in this chapter. It changes both our sales dollars on the top line and the variable cost deducted on the second line proportionately. If unit sales volume increases 10%, sales will increase by 10%, and variable cost will also increase by 10%. That leaves us with total fixed cost to be deducted before arriving at our bottom line net income. Now, one last line to bring in on our revised income statement. The difference between sales and variable costs. We'll call that line contribution margin. Sales less all variable cost equals contribution margin. Contribution margin is not the same thing as gross profit in our traditional income statement on the left. These are different terms with different meanings, with only sales dollars in common. So, our chief concern in this chapter is to look at the results of operations in this new manner. The CVP income statement is also known as a contribution margin income statement due to the new profit subtotal we've just introduced. Let's reflect back on the traditional statement on the left to remind ourselves what's contained in our total product costs. We have both variable manufacturing costs such as direct materials, direct labor, as well as fixed manufacturing costs such as depreciation and plant manager salary. Likewise, our period costs can have both variable and fixed components. Salesmen paid on commissions are an example of a variable period cost. Rent expense paid on an office building would be an example of a fixed period cost. Now, I just want to emphasize that our new income statement takes the variable manufacturing costs from the plant and combines this with the variable period costs to arrive at total variable costs. The new statement does not care to keep product costs together. All variable costs, no matter where their origin, are combined on the new statement. Likewise, this new income statement takes the fixed manufacturing cost from the plant and combines it with any fixed period costs to arrive at total fixed costs subtracted from the contribution margin subtotal. All fixed costs, no matter where their origin, are combined on the new statement. The new statement simply rearranges our existing product and period costs into the two new categories we explored in our prior talk, variable and fixed costs, classified according to how they change or behave to changes in sales activity volume. Here's the formal definition of CVP analysis. Cost volume profit analysis is the study of the effects of changes in costs and volume on a company's profit. CVP. CVP analysis is highly useful in profit forecasting and planning. It becomes a critical factor in setting selling prices, determining product sales mix as a company seeks to optimize the use of its production facilities. Here's the 5 components that determine bottom line profits. Number 1, volume of sales. Number 2, unit selling prices. Number 3, a company's variable cost structure. Shown here on a per unit basis graph, the same cost per unit is what makes these costs vary or change proportionately in total to changes in sales volume. Total fixed cost at a given relevant range of volume. And finally, if a company has several product lines, what their sales mix is. Sales mix is a proportion of total sales among various types of products or services being sold by a company. Let me bring in an abbreviated contribution margin income statement. Sales volume and selling prices combine to give us total sales on the income statement. Variable unit costs are a function of their unit values times volume sold. And finally, total fixed costs are deducted to round out the remainder of a company's cost structure, giving us bottom line net income results. This short statement is showing no profits, a starting point in later discussions. There are key assumptions behind CVP analysis as listed here. The behavior of both costs and revenues is linear throughout the relevant range of the activity index. That is, we can exactly predict all of our costs. 2, costs can be classified accurately as either variable or fixed. Changes in activity are the only factors that affect costs. That activity going forward is sales volume. This implies that variable costs will change as volume changes, but fixed costs remain the same. All units produced are sold. There is no increasing or decreasing of finished goods during a period. What's made during the period is sold during the period. Finally, if there is more than one product line being sold, the sales mix remains constant. If we have an 80-20 split between 2 product lines, if our total sales volume is 1,000 units, that same mix of 80-20 exists if there are 2,000 units sold. Review question. Which of the following is not involved in CVP analysis? Fixed cost per unit. Fixed costs in total are relevant, but not fixed costs per unit. A CVP income statement is one for internal use only. It classifies costs and expenses as fixed or variable. It reports contribution margin in the body of the statement, as we've seen. Contribution margin being defined as the amount of revenue remaining after deducting all variable costs. And it reports the same net income as a traditional income statement. Why do we call that first profit subtotal contribution margin? Sales less variable costs equals contribution margin. CM is the amount of profit remaining after covering variable costs that contributes to covering fixed costs and contributes to producing any profit. So CM will cover our fixed costs and drop to the bottom line if that margin is greater than our fixed costs. There's an immediate implication for contribution margin. It better at least equal our fixed costs. If not, a net loss results. We will see later that each sold unit carries forward contribution margin profit per unit that affects the bottom line. Let's look at an example of a CVP income statement. Here we have Vargo Video Company producing a high-definition camcorder. Relevant data for the camcorder sold by this company are as follows. Unit selling price of the camcorder, $500 each. Unit variable costs, $300 each. Total monthly fixed costs, $200,000. Total units sold during the period, 1,600. We'll come back to this shortly, but make a mental note of the contribution margin. Selling price of $500, less variable cost of $300 or $200 contribution margin. Let's look at the full income statement given this data. Our total sales dollars are a function of volume times selling price. 1,600 camcorders times $500 a piece, $800,000 total sales. Variable costs are also a function of sales volume. 1,600 camcorders times $300 a piece, $480,000. The difference between total sales and variable costs, $320,000, contribution margin, a subtotal of profit. And we deduct out our total fixed costs for the month, $200,000, to come down to bottom line net income, $120,000 profit for the month of June. Let's dissect that result. Let's go back to contribution margin. What's available to cover fixed costs and to contribute to income? Our formal contribution margin per unit definition is as follows. Unit selling price, $500, less variable costs of $300 per unit equals a contribution margin per unit of $200. Let's look at these same relationships with the different unit volumes sold and see how our company does. Here we have Vargo's CVP income statement that predicts a zero net income result. In other words, they're operating at a break-even point, no profit. That comes about when we're selling 1,000 camcorders. 1,000 camcorders times our per unit selling price, $500,000. 1,000 camcorders volume times $300 variable cost, $300,000. Net result in contribution margin profit of $200,000, less our fixed cost of $200,000 gives us no net income for the month. The company is operating at the break-even point, no profit. What happens if our company sold one more camcorder? In other words, not 1,000 camcorders, but 1,001. Here's the new income statement. Total sales, $500,000 and $500. Variable cost, $300,000 and $300. Contribution margin, $200,000, $200. What's the dynamic that's operating here? We sold one unit beyond our break-even point. That one unit, selling for $500, costing us $300, gave us a contribution margin of $200 per product. That one extra product drops right to the bottom line, net income, $200. each unit sold contributes $200 to the bottom line once sales volume passes the break-even point, known as the BEP. We can see that our sales varies based on volume of products sold. Our variable cost also varies based on that volume sold. And so therefore, so does our contribution margin, since it's sales dollars less variable costs. A key relationship of this entire chapter is the sales less variable cost equals contribution margin relationship. That one extra sale over 1,000, in other words, that 1,001 sale gave us an extra $200, which is reflected in contribution margin, and it drops right to the bottom line once we bypass the break-even point. So after BEP is reached, the full contribution margin effect is felt at the bottom line. This is a relationship to be fully studied in this chapter. We can also express contribution margin as a ratio. That is, we can show the percentage of each sales dollar available to apply toward fixed costs and profits. So the formula for contribution margin ratio and the computation for our company are as follows. Contribution margin per unit, $200, divided by unit selling price of $500 gives us a contribution margin of 40%. That means for each sales dollar made, 40 cents of that is profit at the CM level. Let's look at our last income statement. Total sales, $500,500, selling 1,001 camcorders at $500 a piece. Total variable costs, $300 times those 1,001 camcorders, $300,300. Contribution margin, $200,200. Contribution margin divided by total sales, $200,200 divided by $500,500 is 40%. 40% of each dollar is profit at the contribution margin level. Now let's use this 40% contribution margin ratio to predict a change in profits. On the left, we have our income statement at a break-even point. We're selling 1,000 units. In other words, $500,000 in sales. Those 1,000 units translates to $300,000 variable costs. Contribution margin of $200,000 exactly from fixed costs, no profit. Second scenario on the right, we increase our sales by 200 units or $100,000. 200 units times $500, $100,000 increase in sales. These 200 units are completely beyond our break-even point. So how much is going to drop down to our bottom line in income? Those $100,000 in increased sales times 40% contribution margin profit will drop right down to the bottom line, $40,000. Said otherwise, once we're beyond break-even point, once we're selling more than 1,000 units, our bottom line profit will be affected directly by the contribution margin level. So at 1,200 units on the right being sold, that's 200 units beyond break-even point, 200 units times $200 contribution margin translates also to $40,000 net income impact bottom line. It's useful to be able to deal with contribution margin at the per unit level as well as the percent of sales, the ratio expression. Review question. Contribution margin is both A and B, revenue remaining after deducting variable costs, and may be expressed as contribution margin per unit. Cost of goods sold is only relevant in the traditional income statement, not the cost volume profit or contribution margin income statement we're dealing with in this chapter. Okay, let's backtrack to this term break-even analysis. What is it? It's the process of finding the break-even point, the level of activity, sales activity, at which total revenues equal total costs, both fixed and variable. It can be computed in three ways: from a mathematical equation, by using contribution margin, or from a cost volume profit graph. We can express it either using the sales units or sales dollars. BEP analysis reaches back to the sufficiency of contribution margin. Fixed costs are fixed. They're not changeable in the short run. So what drives contribution margin so as not to lose money? The sufficiency of selling price and the predictability of variable costs. Let's look at a calculation of a break-even formula using a mathematical equation. Now, this equation is simply that all our sales, less all our variable costs, and all our fixed costs will equal zero at the break-even point. That's our starting point. An example here, we had a sales value of $500 per item sold. Q is a designation of volume. Our variable costs are $300 for each item sold, and our fixed costs per month were $200,000. So our generic formula at the break-even point, $500,000 selling price times quantity sold, minus $300 variable cost times product sold, minus $200,000 equals zero. Let's begin to isolate our Q quantity on the left-hand side. We'll add $200,000 to both sides, and then the result is $500,000 times quantity sold minus $300,000 times quantity sold equals $200,000 fixed cost on the right-hand side plus zero net income, no change. Further reducing it, let's just simplify that second line. $200,000 remains on the right-hand side since there's no net income. The left-hand side, our $500 selling price less $300,000 variable cost reduces to a $200,000 times quantity equals $200,000 fixed costs. That $200 is our contribution margin, selling price minus variable costs. So our expression is Q quantity equals $200,000 fixed cost. Divide both sides by 200, and we have the formula fixed cost divided by contribution margin per unit equals our Q, or our break-even quantity, of 1,000 units. Again, Q is the sales volume in units, $500 is our unit selling price, $300 is our variable cost per unit, and $200,000 is our total fixed costs for the period. Bringing a recap, our sales per unit less our variable cost is our contribution margin per unit, $200. That being the denominator of a formula to arrive at our Q, or our break-even point volume, the point at which if we sell those units, 1,000, we'll have no loss, we'll have no profit, we'll have zero profit. Let's recap what we just did here. At the break-even point, we want to know the quantity needed to sell to not lose money. The BE point in sales quantity equals fixed costs for the company divided by contribution margin per unit. This formula and a variation will be used extensively in this chapter. BEP can be expressed in either sales units or sales dollars. If we're given a unit calculation of BEP and the selling price, we can calculate sales dollars, or we can do the reverse. If we're given sales dollars and the unit selling price, we can calculate BEP in terms of units. Let's go back to this break-even point definition. Contribution margin dollars must equal total fixed costs. That is, all costs are covered and no profit will result at the BE point. And what are contribution margin dollars? Total revenues minus variable costs. Sales dollars less variable costs equals contribution margin minus fixed costs equals net income. The break-even point can be computed using either contribution margin per unit or contribution margin ratio. Let's revisit contribution margin in units. When the break-even point in units is desired, the contribution margin per unit is used in the following formula. Fixed costs divided by contribution margin per unit, $200,000 divided by $200 equals 1,000 units. Break-even point in units. That's our Q. At that level of Q, or level of sales volume, we'll make no profit. Let's calculate contribution margin using a ratio. This will give us not units, but units in dollars. So if the break-even point in dollars is desired, we'll take the contribution margin ratio and divide it by our fixed costs. So $200,000 divided by 40% gives us $500,000 break-even point quantity in dollars. Said otherwise, if our break-even point was 1,000 units, 1,000 units times our selling price of $500 is our break-even point in dollars, sales, or $500,000. There are three ways to express contribution margin. 1, absolute dollars. 2, dollars per unit. And 3, percent of sales, the ratio that we've seen. Let me use the following simple example to express this. Let's say we have sales of $500 in total of 5 units. Our variable costs are $300. Contribution margin in total is $200. So in absolute dollars, our contribution margin is $200. Our contribution margin on a dollars per unit basis is $40. That is $200 divided by our 5 units sold. Or our contribution margin as a percent of sales is $200 divided by $500, or 40%. There are three ways to express break-even point. Graphically, charting out costs as well as revenue lines, not very popular. A mathematical equation using the formula total revenue minus total costs equals 0, or no profit. This needs all the revenue and cost assumptions, selling price, variable cost per unit, and fixed costs. The mathematical equation has all the ingredients to jump to the last method, using contribution margin per unit. This is the most direct and useful approach. It just relies upon all the information from the full mathematical equation approach. Expressing a break-even point using contribution margin is easiest if the contribution margin per unit is straightaway given. Or a problem may give you both the selling price and the variable cost per unit, allowing calculation of the contribution margin per unit above. Else, a problem may simply present absolute contribution margin dollars, and you just need to look for the units sold to again calculate the contribution margin per unit. Or a problem may present the contribution margin as a percent of sales, the ratio expression, which is then multiplied out to obtain the contribution margin in dollars, and then continuing on to calculate contribution margin per unit using the units sold. Or a problem might even present variable cost as a percent of sales, which has to be converted into contribution margin as a percent of sales, which is simply done, since both the variable cost percent of sales and the contribution margin percent of sales must equal 100%. Once the contribution margin percent is known, which is number 4, that's converted into contribution margin dollars, which is number 3 above, which can be converted into contribution dollars per unit using sales units. All the variations are related because they're all based on the CVP income statement we started with. Sales minus variable cost equals contribution margin profit, less fixed cost equals net income, bottom line profit. Here's a graphic illustration of the break-even profit calculation. It shows costs, volumes, and profits. At the bottom, we see the fixed costs of $200,000 per month, fixed cost line shown. We also bring in our variable costs, and we see our volume units down below on the x-axis. On this graph, we then need to bring in a total revenue line, total sales line. The intersection of the total sales line with the total cost line is our break-even point. In this case, $500,000 or 1,000 units. So above that is our profit. Revenue is outstripping total costs, and profit is generated beyond that break-even point. Again, this is not a very popular method. It will not be emphasized in this chapter. But let's take the data from this prior graph. All we need is basic readings and a few calculations. We saw the fixed costs at $200. We could calculate our variable cost per unit at 30 cents, which is our total cost of $500 less our fixed of $200. So variable cost of $300 divided by 1,000 units gives us 30 cents per unit. I was using the break-even point as our starting point. Our selling price per unit, 50 cents. At a break-even point, it was $500 and 1,000 units. And we were at our break-even point at that 1,000 unit sold, or Q. We can cross to the y-axis, $500 in sales. Sales expressed at the break-even point. We can convert all this data into the mathematical expression. 50 cents a unit selling price times 1,000 units. 30 cents a unit variable cost times 1,000 units sold. Minus $200 fixed cost equals 0, our break-even point. The expression on the left, selling price 50 cents times 1,000 units minus 30 cents variable cost per unit times the selling times the number of units sold, is our contribution margin, $200. $200 contribution margin less $200 fixed cost equals 0 profit, break-even point, 1,000 units sold. Question. Gauss & Company is planning to sell 200,000 pliers for $4 per unit. The contribution margin ratio is 25%. If Gauss will break even at this level of sales, what are the fixed costs? I suggest you pause this video and attempt a calculation. The answer is $200,000 of fixed costs. How do I arrive at that? Brought in the formula, sales, $800,000, which is the 200,000 volume times $4 per unit selling price. Variable cost is unknown, but it's given that the contribution margin ratio is 25%. That is, 25% of net sales is our contribution margin in dollars, or $200,000. Fixed costs need to be $200,000 for net income to be 0. The answer, $200,000 in fixed costs in this problem. Another example, Lombardi Company had unit selling price of $400, variable cost per unit of $240, and fixed cost of $180,000. Let's compute the break-even point using the mathematical equation. First, sales, $400 times quantity sold. Variable costs, $240 times volume sold. Fixed cost given $180,000, and we're solving for a 0 net income, or break even. The difference between our sales revenue and variable costs gives us our contribution margin, $160 per unit, per sales unit, equals what? Our fixed cost of $180,000. Let's simply solve for Q, divide both sides by 160, and Q equals 1,125 units, break-even point. Let's do the same calculation using contribution margin per unit directly. All we need is our formula, total fixed cost divided by contribution margin per unit, 160. That equals 1,125 units, break-even point. Much more direct if you jump right down to CM per unit and using fixed cost in the numerator. The calculation gives us the Q of break-even point, the quantity needed to be sold to break even, not lose any money. Again, as CM per unit is known, most direct approach, simply divide that into fixed costs. It's useful to keep this simple graphic in mind of an income statement when solving problems related to this chapter. Oftentimes, we're simply solving for the missing piece of financial data. An income statement is simply a subtractive approach, sales at the top, plus all costs coming down to net income at the bottom. Net income is the amount of sales revenue left over after all costs have been subtracted. If we're given data at the bottom like total profit, we can add up. For instance, if we're given net income and total fixed costs for a period of time, we can calculate contribution margin by simply adding the two. Net income or profit plus fixed costs will give us contribution margin. Once we know contribution margin, if we know variable costs, we simply add those two together to derive sales revenue.